Welcome to the Thematic Edge podcast. I'm Marvin Barth of Thematic Markets. This week, Mark Farrington of the Global Watchtower and I had the opportunity to interview Zoso Davies on the state of global credit markets and how the Iran war has increased credit risks. I was fortunate to work with Zoso at Barclays, where he was a managing director in European investment-grade credit research and was known for his excellent top-down perspectives on credit risks. In addition to making him one of the street's top credit analysts, that made him an ideal co-author for me and others on thematic cross-asset research. Over 15 years at Barclays, Zoso was a leading authority on the European sovereign debt crisis, Greece's sovereign restructuring, Brexit, COVID, and the effects of post-COVID reflation on credit. He now works at a leading London-based hedge fund and writes the brilliant Substack Macro Credit Thinking, which you really should check out. Hence, when questions began to arise late last year about risks in private credit, Zoso was the first person I thought to call. His schedule wouldn't align until this week, but as luck would have it, it couldn't be better timing given the rising concerns that Mark and I have for broader credit risks amid the supply shock to global energy and petrochemical markets from the Iran war. In this interview, we talk about Zoso's framework for thinking about credit risk and how that dovetails with my theme of being is believing. We explore markets' concerns about private credit, a market that Zoso rightly notes is amorphously defined and, prior to Iran, was not a systemic worry but a potential single industry worry in software. But all that changed with the Iran war. As I wrote in Alia Iacta Est, the die is cast, the potential for a longer, more disruptive Iran war and extended supply disruptions threatens economic growth, revenues, and credit quality far more broadly. Looking around the world, Zoso shares our concern that European credit looks most exposed. We also talk about how regulation and supervision of pension funds creates a natural amplification of credit tightening once that process begins. But we start with a conversation about life's serendipitous path to career that may be of more interest to young graduates in an age of AI displacement or to parents like myself. Namely, how did Zoso translate a PhD in physical chemistry from University College London and an undergraduate degree in chemistry from Merton College at Oxford into a career as a leading credit analyst? Before we begin, I just want to remind everyone that nothing we say should be construed as investment advice. Everything here is for informational purposes only, and that you need to do your own research before investing in anything. With that, please enjoy our conversation with Zoso Davies. Zoso Davies, welcome to the Thematic Edge.
Hi, Marvin. Thanks. Thanks for inviting me.
This is something I think Mark and I have both been really excited about. We've actually been trying to get you on here for, I think, at least a couple of months now, because both of us have been concerned about these rumblings that we hear about private credit, as I think we'll get into in the discussion. For various reasons, I think both of us have been quite skeptical, but now are starting to get nervous because of the change in circumstance, which we'll get to. But I would really like to start with what I think may be the most interesting question, frankly, for most people, which is how does somebody with a PhD in chemistry go into credit research? I mean, that doesn't seem like a straightforward transition. And in a world where lots of young people are worried about, how they're going to get a job in the age of AI, this one might be useful to a lot of different people.
Sure. It is definitely an interesting story. I don't know how much fear or inspiration it will bring, but I'm always happy to share it. So I was getting to the end of my PhD in 2008, and I had a friend, a good friend, who was actually in interest rate sales at an investment bank. And at UCL, third part of the story, they had a program where they would do quantitative finance. So I asked my friend, I said, hey, what's quantitative finance? I know what quantitative means. It means numbers. And I know what finance means. It means we make funny stories and we just, shoot the wind. So how do we put these things together? And he said, look, we've got a load of computer people in the back office. And my PhD, I'd done reasonable amount of coding and problem solving and mathematics. There was a big mathematical element to the chemistry I was doing. And I thought, cool. Recall this is 2008. I was like, cool, I can get paid bank wages to do coding. This sounds like a great deal. Hindsight would have been better to go to a tech company to do coding, but you live and you learn. Um,
Depends
and
on
it
the
was
company.
yeah, like, it turns out you can just be wrong all the way through this process and still end up in a good spot. So I started looking into these roles. So, the first thing I learned was there's a lot of roles in finance. There's a whole bunch of roles that I've never heard of. I think people outside of finance look at banking really like that bull pit, people shouting trading floor scenario. Number one, trading floors don't look like that anymore. And then you just have so many other
They're
roles.
so
So
silent nowadays.
yeah. So the big learning point there for me was there were a lot of roles in finance that I'd never heard of. Then 2008 came, and it was in some ways a bit liberating because essentially no one anywhere was hiring in the tail end of 2008, beginning of 2009. As an app, I mean, yes, the job market is incredibly tough for young people now, but it was also unbelievably tough in 2009, 10. People coming out of university and just going into multi-year unpaid internships just to do anything with their time. And so what that forced me to do was to apply
But
for everything.
can I interrupt you there just to highlight
Yeah.
that point? Is that there was this famous Citrini piece talking about the AI destruction of white collar jobs, and if you look, I wrote a piece on that, the AI apocalypse, and you just take those exact categories that they highlight in that and look at what those did in 2008. You want to talk about job losses? Like it was so much worse in
Yeah.
2008 than it is now.
Yeah.
So, I mean, just people need to keep a little perspective there to exactly your point. So please go ahead.
Yeah, yeah. And look, how do you respond to that? Well, I applied to a lot of different jobs. I applied for a job at the FSA. I applied to be a teacher. I applied to a lot of different things. And it turned out that one of the few places that was hiring was actually Barclays. That was the bank I went to. They were hiring because they'd just bought Lehman in the US, and had also got a chunk of Lehman Europe, and they were taking on summer interns. And so I said, "Hey, quantitative finance, what do you think?" And they turned around and said, "No, no, thank you. We only take maths and physics PhDs." I thought, okay. And then they came back and said, "Well, what about research?" I was like, It's 2008. Sure, let's go for research." I went for a summer internship. I thought, not everyone here is going to have a PhD. It turned out that that was true, but everyone else did have three prior internships at like Goldman, MS, BAML. I went through, at the time, it used to be a 3-day selection process, so it was quite intense. And I got to the end, and the last part of this process used to be that, and I now have seen it from the inside, all the CVs for all the candidates would be put on a table, and the various teams would look at the CVs and say, these are the people I want to interview. And so to like contextualize, the people who asked me for an interview were HR, a gap, somebody who he had done his PhD with my PhD supervisor and just kind of wanted to ask how Andrew was doing. And then HR asked the convertible bonds team if they'd come and talk to me because no one else was talking to me. So it wasn't an auspicious start. But you know what? The HR team found me a role. So that internship had been on the equity side of the business. They actually found me a role in what at the time was called flow credit strategy. So I got to do my internship and I got to tell everybody I was working for the team that had just blown up the world because we were doing CLOs and correlation. So that was quite good fun. I worked through that. I failed my internship. I got told that I wasn't very keen on financial markets. But somebody 2 rows down resigned, and the head of that team said, "Do you want to do a second internship?" I thought, "Sure, fine, let's crack on." I did that, and they took me on. And then I joined in February of 2010, having done this sort of 9-month internship. And 2 weeks while I was off desk doing my training, because at the time you used to get a month training before you started, my manager resigned. So I came back to the team. I was just like, cool. So, I guess someone's sat there being like, "Oh, what do you do?" And I think that the point is, you know, wherever you are in life, you think you know what the next step is. 99 times out of 100, you don't. But the trick is that you just keep walking forwards and doors will open and you step through those doors. And, maybe a different path. I wouldn't have worked in finance for 15 years. I wouldn't be here talking about credit. But I've got to believe that at some point a door would have opened and I would have found a career and I would have been able to keep moving forwards. And I think that adaptability in this question about AI and what's AI going to do, and it's going to do what all technology has always done throughout the history of humanity, which is it's going to make things change. And the trick is to roll with that change, you to adapt to it and to just keep moving forwards. And, the world will carry on. The world will rise tomorrow. It rose after the GFC, it rose after Brexit and all the other massive events that people thought 9/11. It turns out the sun will rise tomorrow and people will still need you to do a job.
Yep. Yep.
Yeah, I think that path dependence, a baseball player from rural Oregon like Mark, and a guy from a farming town in the Central Valley of California, both of whom have had careers all around the world, and we never anticipated that. So, to exactly your point, and actually, one of the best things I've seen on this whole AI apocalypse out there was there's this comedian Dominique Frisby who also writes on finance, and he highlighted, hey, just take a look at Chaucer's Canterbury Tales. Every single one of those careers he writes about still exists 800 years later, despite the Industrial Revolution, all the English Civil War, all these different things, they still exist. So anyway, look, let's get into credit because I
Okay.
think that's why we really wanted to have you here. And I think you have a really interesting way of looking at credit. And maybe that's just my own personal prejudice, but I think Mark, you also found this perspective very interesting. But I have this theme: being is believing, and most of my readers and clients think of this in terms of how it affects inflation. But my point is that it is a broader phenomenon that once a belief starts, it can very often become self-fulfilling in reality. And you relate that to credit. And so, could
Yeah.
you just highlight what is at a big level, especially for people who aren't credit people? How do you think about credit?
Sure. So I'm primarily working investment grade credit. So I think that's an important caveat, and we'll come back to that around the question of private credit. So what's investment grade credit? It's high quality companies. Formally, it's done off a rating, so it'll be a triple A or a double A or a single A or maybe a triple B company. But these are all high quality companies. And to put some perspective around that, the annualized default rate for investment grade credit is around 0.2 percentage points, right? So in any given year, 20 out of 1,000 companies will have some sort of credit distress. And that's distress and defaults become an interesting legal game about what exactly they mean. But let's just say that the company is either significantly downgraded or it may even have to restructure or default on its debt. So it's pretty small. So if you then think, well, how much, from a finance perspective, how much should I be compensated for that risk? It's a pretty small number. If you know that if you have a properly diversified portfolio of 1,000 companies, 20 of them are going to get downgraded or get into some trouble. You're going to have to sell those bonds at a loss, but the other 980 are going to be fine. How much do you charge as risk premium? It's quite small. If we then look at what the market actually really pays you, it's much larger than that. It's much, much larger than that. It will usually pay you between, for investment grade credit, and depending on where we are in the cycle, 100 and 200 basis points, so about 2 percentage points, compared to that 0.2%, which is your actual loss rate. And so the whole difference in the between those two numbers is compensation for two things. One, liquidity, your ability to actually buy and sell corporate bond risk, which is significantly lower than mega cap shares and government bonds. It can be decent, but it costs you money to trade these things. And two, mark to market volatility. The fact that you have to watch the prices go up and down and you have to be compensated for that volatility. And there are formalisms around that in terms of Sharpe ratios and portfolio construction, but just fundamentally, you want to get paid for things moving up and down. And the reason I find that framework useful is it then tells us a lot about what we should worry about. How much time should we worry spending about the zero point 0.2 percentage points of losses, which sometimes goes up to 0.3 or 0.4? And how much time should we worry about the movement up and down of the market in general? We
Hmm.
spend a lot more time on that. And then when we think about what makes the market go up and down, to a first approximation, you can just say vol. And the reason I use vol is because vol is volatility is it's very encompassing. It might be volatility due to geopolitics. It might be volatility due to new technology. It could be volatility due to specific credit sector actually getting in trouble, and we don't quite know which companies are the worst ones and which ones are going to be okay. But uncertainty. And so actually, I spent most of my career running around saying, what's the story? And is the story going to get better or is it going to get worse? And that's where when we were working together, we had a lot of overlap because we spent a lot of time saying, what's the story? Is the story going to get better or is the story going to get worse? Because the movement in that narrative will always be two or three orders of magnitude more important than the actual evolution of balance sheets in investment grade. As you go down in quality and those default rates start to pick up to sort of 200, 300, 500, 700 basis points, that balance shifts and you spend a lot more time working out if the company is going to give you their money back. But at the high quality stuff, it's much more about just understanding the stories that the market's telling and those key points when that story flips and you kind of get this narrative shift.
Yeah, I mean, look, I hate that you're giving away that we're all just a bunch of storytellers, but come on, don't show them, the Wizard of Oz behind the curtain. Come on, but just correct me if I'm wrong here, but if I recall correctly, the AAA tranches of all that subprime debt that everyone was so worried about in 2008 never did default. They actually did pay. Is that not correct?
So in Europe, yes, and in CLOs, yes. I think there were some impaired parts in the US
Okay.
for residential mortgages, and
Mm.
where you see impairments in investment grade, that this overlaps very tiny. Where you do see impairments in investment grade is basically fraud.
Yeah.
Okay, so
Okay.
it's very rarely this your balance sheet's good and it kind of suddenly evaporates.
Mm.
That can happen with banks. So the other one is Lehman. So banks have a balance sheet that essentially runs on confidence, and confidence can evaporate very, very quickly. So when
Yeah.
you get a confidence run on banks, they can go from investment grade to default. You also saw that with Credit Suisse. For non-financials, 99 times out of 100, if a company goes to default from IG, it's fraud. And I would say that, ninja loans, liar loans, they kind of fall under that. So in that case, there was an issue, and the issue was that the mortgages were not legally, but, morally fraudulent.
That's an important financial term, morally fraudulent. I like that.
I'm not saying my opinions would stand up in a court of law, but I think most people would agree with the sentiment, right?
Absolutely, couldn't agree more. Look, that's fantastic, Zozo. I'm keen to get into private credit as soon as possible, since I think that's the headline that seems to grab the most attention these days, thanks to a few high-profile events like Blue Owl and
Mhm.
First Brands, etc. And actually, because I'm not a credit analyst like you, I'm a macro guy, and I'm looking at this relative to previous credit cycles. So, first, let's even start with that. I mean, we really haven't had a big credit cycle since 2008 global financial crisis.
Yeah.
And I think if many of us in the market would have expected one, We would have thought it happened in 2022, 2023, when inflation was spiking and the global central banks were tightening. And the fact that we managed to sit through that 2 year spike in rates, I think created a false sense of security that, maybe we're all right, and banks and non-bank financials have learned from the past, and they're well prepared for what comes ahead. And then now with this conflict in Iran creating this potential tail risk that might produce another global shock, people have started to question whether the staying power is there or not. And I would love to hear you talk about, how big of a credit cycle you think this can potentially be, what needs
Can
to
can we
happen.
can we can we actually break that down? Let's get to the Iran
Yeah.
stuff later. Let's start with like the germs of what like 2 months ago, before anybody had ever heard of Iran, there were already these credit things.
Yeah.
So should we have been worried then, and what should we have worried about? And then let's get on to like the other layers on top of this. Like I think it's good to break this down into a segmented thing.
Yeah, I didn't want
So
to relate that to Iran. I wanted to relate that
yeah.
to something, a macro event that lasts long enough that it creates the pressure that you start to have default risk. And so the inflation one was sort of too quickly replaced with the Iran one, but it's more this question about, is the pressure there to create the stress?
Okay. Well, like a man with a hammer, everything looks like a nail. So I'm going to take my framework and I'm going to, smack this narrative with my framework. Um, so I think with private credit, unfortunately, there is a little preamble. Credit is not one asset class. It's actually a family of asset classes that get mushed together.
Hmm.
Private credit has the same issue. So depending on who you ask, private credit is anywhere from 1 trillion to 5 trillion to, I think, the head of Apollo was quoted as putting tens, 20s, 30 trillion on it. The perimeter is very loosely defined. So generally, the perimeter would be considered a, a loan or a debt instrument that's not publicly traded. The head of Apollo has said anything that doesn't have an ISIN on it. If you actually look at that, most of that is mortgages, and then it's bank loans. And then you kind of get down into the other bits and pieces, but the other bits and pieces are actually a very relatively small piece of that pie. So, you've got two different axes. You've got private and public, and you've got high grade and low grade. Most private credit is high grade. It's high quality. I'm going to consume that my mortgage is high quality, and that most mortgages are high quality because, people have a high tendency to pay them, particularly in Europe, and it'll also be their asset backed. What happened with some of the major private credit lenders was there was this deliberate fudging of what we were talking about. So if we look at like an Apollo or an Ares, what you had is that they were very, very successful, high yield, stressed and distressed lenders. They were very, very good at lending to high yield companies, low rated companies, companies that were maybe in stressed or distressed and generating high returns. And during the zero interest rate period, they were kind of selling themselves as, hey, don't get 0% on European investment grade credit or negative on the government bond. We can get you 3 or 4%, which looked incredible at the time. And then 2020 came through. There were some technicals around that where a lot of actually relatively good quality debt came out of bank balance sheets. They kind of went through a forced deleveraging because of how the regulatory framework operated in 2020. So they picked up these assets that were relatively cheap and that ex post, the default rates were quite low. So they had a really good track record. And then you've got this marketing push. How do we grow? Because the European high yield market is around 300 to 400 billion dollars. The US high yield market's about $1 trillion. How much of that pie can you get? And so what you do is you start extending the boundaries of private credit to convince your shareholders that you can continue to grow. And so then you come up with this narrative that private credit is huge and it's everywhere. But you've done that by starting to bring all of the high quality investment grade stuff into your perimeter. So now there's a real blurring of how big private credit is versus how much leveraged lending is. And leveraged lending, recall, is where you actually start getting the more material defaults. And that was a marketing push I end up in these conversations referring to Apollo a lot, not because I have any particular view on them, but because they've been extremely vocal about how they view the world and this conversational narrative that private credit narratives, private credit is going to go and go and go. What's now happened is that's turned around and bitten them in the bottom, right? Because now everyone's swallowed that story and said private credit's huge and it's everywhere. And that means it's going to be the end of the world. But ultimately, 80, finger in the air, 80, 85, maybe even 90% of that is investment grade stuff. A great example of this is the story around insurers. Insurance companies, particularly UK ones, because I know them slightly better. If you look at what they disclose, they'll say we have a huge amount of private assets. Private assets. If you look at what those assets are, they're infrastructure lending, they're direct lending. These are loans that they've basically underwritten as if they were a bank. They're still an insurer. They do put an internal rating on it because of how the regulations work. But these are real insurers. They work really, really hard to make sure these bonds are paid back, right? This isn't leveraged debt. And people are running around saying, oh my God, insurers are stuffed full of private credit. Well, yes, but it's investment grade private credit. So you definitely have you've got a story that's got out of control. It's basically got out of control of the people who are using it to build their business and build their narrative. And where that's really come to say a focus would be something around like BDCs. So BDCs, again, they are a family of products, but the ones people are going to be most aware of is that they are publicly traded shares. They're an investment company, and the company invests into loans, mostly loans of moderately leveraged businesses. We're in the high yields now, right? So we're in the double Bs and the single Bs. And if they invest in certain types of company, they get tax relief. So what you have are these shares that pay you these quite large tax-free dividends. Cool. Okay. Have we seen in those portfolios a material uptick in loss rates? Actual loss rates? No. Have we seen significant signs of distress? We've seen little bits of distress. There are certain types of debt called PIK debt where people toggle on and off the coupon. And we've seen certain companies using that toggle. What that does is that improves their free cash flow, but it makes their
Pick
balance sheet
pick
worse.
being payment in kind. So
Payment in kind.
you can basically pay your coupon by issuing more debt
Yes.
effectively. You have
Yes.
that option. That's what you mean by
Yeah.
the toggle.
Yes. And so you've seen if we look at the balance sheet, that little bit at the bottom, things aren't yet screaming alarm bells. And if you look at the structures themselves are not obviously excessively leveraged. I say obviously because remember, there's always that caveat of sometimes fraud. But let's assume there's no fraud.
Yeah.
I'm not suggesting there is, but we always have that caveat when we do credit. And we had that with something like Tricolor and First Brands, right? It turned out that one or two of those, it's looking like there was maybe some fraud in the First Brands case. So the credit isn't really deteriorating yet. Could do, may do over the next couple of years, but at the moment, that's not the problem. The structure itself is not inherently over leveraged. What's the problem? The problem is everybody hates private credit and everybody wants out. That's the problem. That is the problem. The problem is that
So it is the
everybody wants
story.
out. Everyone wants out of BDCs, and BDCs, the public ones, you can sell them, but then you sell them at a massive discount to NAV, and the private ones are not liquid. They don't promise you liquidity. And so what you then get is this waterfall of headlines. Blue Owl's closing, Apollo's closing, Ares is closing. If you
Mhm.
speak to the management of the companies that offer these products, they'll look you in the eye and say, "Look, we have two products. We have a publicly traded BDC where you can get in and out any day at the price on the screen. The price on the screen may not touch NAV. That's a market view, right? And you get compensated for that mark to market vol. Or we have something that offers you zero vol, and you don't get your money back. You get your money back when we feel that we can meet that redemption without causing too much damage to the underlying portfolio and other investors." And that was always true. But they've lost control of the narrative. The narrative is being run by the FT and the Bloomberg and other news agencies. And so every time one of these funds gates, it's another headline. More people want to get out because once a run starts, it's never rational to start a run, but it's always rational to join one. And so that's what it feels like. Right now, there is a run on private credit. We are witnessing a run on private credit. They have tools to manage that, such as redemption withdrawals and gating. Okay, but that is the real issue. The real issue with private credit is not that we saw defaults spike from 1% to 20%. The issue is that there's a confidence crisis in private credit. Everyone's scared about it. And there's now a run on private credit vehicles that is, the regulators, unlike with normal banks where the regulators or the central banks would step in to try and assuage the run and try and cut it off, the regulators are sat around being like, oh, actually, we want to know what's going on with private credit. We want, they kind of add into the angst and the anxiety.
Yeah.
And the private credit providers are kind of on their own, kind of saying, well, hang on, we don't have any defaults. True, but that's not the problem you're facing, my friends. The problem you're facing is that people want their money back, and they've suddenly realized that, they kind of convinced themselves they would be okay, but they're
So,
not getting their money back.
I mean, look, we could have, and maybe we should have you back sometime to have this discussion because, I mean, like, I've written a lot, and you and I in the past have had very long, detailed questions about just how ridiculous Basel III rules are. But it is, to your point, it's just like tremendously ironic that the regulators who created this, who forced all of this stuff out of the banks, are now saying, yeah, we should really understand more about that. But let's leave that discussion aside. One thing, to get back to some of Market's point, like, there is a whole daisy chain here in
Mhm.
terms of how all of these risks sort of bleed together that I think is becoming more concerning. But if we stick with the sort of pre-Iran world, um, I mean, I think one of the reasons why, at least I was, and I think Mark is in the same boat on this, in terms of being less concerned about these credit risks, is when you talk about a run on private credit, as you say, the public BDCs, you can get in and out anytime you want, whatever you want. And there's a NAV that you can trade against. So no worries here. There's no liquidity issues. There's nothing to be concerned about there as far as I'm concerned. And then on the private side, I mean, first of all, there's a lot of these funds have lockups of staggered maturities. When they do have non-lockups or they have open window periods, they can close those. They can gate them if they want. This is very, very different from a bank run. A bank run, people presume, at least in theory, are supposed to be able to get their demand deposits on demand whenever they want. So to your point about rationality, it's not rational to start a run, but once one started, you'd better go down and get to the bank, get your money out before everybody else takes it out. That's not the situation we face here. So the systemic issues, correct me if I'm wrong here, but before we get to
Yeah.
recessionary impulses or
Yeah.
actually something that changes default rate significantly, the story you've told me is one where there's a lot of hysteria on the FT, which, the Secretary of the Treasury this week rightly slapped down for their, yellow journalism. Um, but pink journalism, I don't know.
Yeah. Yeah.
Um, but should I have been worried about this before we get to the sort of default situation?
So I think the answer is not then, maybe now. And it comes to this sort of issue. So bank runs are problematic because they're a societal problem. Like bank runs can fail banks, and when banks fail, that has broad societal implications, and that's why we have central banks as a liquidity backstop. We've kind of seen that.
Yep.
With all due respect, and again, I'm not picking on any particular name, just well-known names that hopefully the listeners will be familiar with. If KKR blew up tomorrow, does anyone really care? Like from a societal perspective, right? in isolation,
There
the
might be
shockwaves.
there might be a bunch of people out there actually cheer that, but
Yeah, yeah, right. So like
not that I
there are
would, but
shockwaves and second orders, but like on the day to day, like if when in this country, NatWest essentially closed the door, people couldn't pay their bills, their standing orders cancelled, they couldn't get the economy stopped, right?
yes.
Yeah.
If KKR tomorrow said, you know what, we've got a massive hole, we're going to have to wind down our portfolios, the US economy would not stop. A bunch of very large institutions would have some losses they'd have to absorb, and some large wealthy individuals might take hits to their 401k. But like the economy rolls on. Because banks are also the plumbing to our economy, their failures become much more systemic. So I think that's important. The bit where I say but maybe, it comes to again the story, which is I've said to yourself and many people, my theory of credit is you go bankrupt when no one will lend to you. Okay. No matter how bad of a company you are, if someone will lend you more money, you can refinance your debt, you can pay the next coupon, you can pay the next bill. As long as somebody will keep lending you money, you can carry on. And this is fundamentally how all startups begin. All startups begin with somebody's willing to keep lending you money in the view that down the line this will work its way out. I think the concern has become pre-Iran, you had a building narrative, and the narrative was something like this. AI is going to be highly disruptive. Some companies are not going to survive that disruption. In particular, the software sector looks vulnerable. Now, if you talk to software specialists, there are a lot of challenges to that conversation, but let's run with it. Then you say, well, where's the software lending? Well, an AI, depending on again how you draw the perimeter, is something like 35% of the US stock market. It's about 8% of credit markets. So even if 25% of those names go away, which would be 200 basis points, which would be vast for investment grade credit, as we've discussed, would be 100 times bigger than what you normally see. It's 2%. But if you then start going through, it turns out that a lot of these private credit and BDCs have a much higher exposure to software, 25, 30, 35. One of the particular ones had just launched a technology private credit because 6 months ago technology was hot. So they launched a BDC really focused on technology. So of course you now look at their portfolios and you go, well, hang on, if 25% of the companies disappear, 25% of their portfolio disappears. And that does start to look like GFC scale defaults, right? GFC in the US got up to like the high single digits, eights, nines, tens. Um, Again, slightly depending on how you count a default. So if you've got 30, 40% of your portfolio in software and one in four of those companies could potentially disappear, now you have a problem. And then you have this self-referential problem, which is, well, if everybody's worried that these software companies are not sustainable businesses long term, are you going to lend to them? No. Which then becomes self-fulfilling because if you don't lend to them, they're going to default. And so because so much of their financing appears to have come through the private credit channel, tightening the private credit channel can in and of itself cause some of those companies to fail when you hit the point where they need incremental capital or they just need to refinance. And the better quality ones will transition back to the public markets, but there will be a number of those companies where there's essentially nowhere to go. And unless the equity sponsor is going to put more equity in, that's where you will start to see debt restructurings and defaults. So you are seeing a path forward which could lead to rising defaults. And it looks like no one wants to lend to these companies. Maybe private credit lenders do really believe in these companies and believe they're valid and would be willing to refinance them, but they're not going to be able to do that if there are outflows and if they themselves are struggling to continue to accumulate capital and inflows.
So,
I
I mean,
wonder, Marvin, if I can just jump in here for
yeah.
a second with on that point Zozo made about the difference between a run on banks and the run on the non-banking sector. In my opinion, the ecosystem effect does have a similar pattern when you have different investors in private credit that have different reaction functions. So you have your high net worth individuals and you have your people who will react to a change in perceived macro environment and therefore preempting an asset class which they think will underperform another asset class. And so they just want to sell and get out and move on. And too much of that behavior then starts to disrupt the other members of the ecosystem who are buy and hold investors like pension funds and life insurance companies who never have any intention of selling, who just want to sit through it because they trust the default data history that you've highlighted. But they get panicked into selling eventually because the other group of investors in the ecosystem are asset allocating away and demanding, withdrawals and forcing the gating behavior we've seen, and that creates the hysteria. And these buy and hold investors, even if they still believe in the math and they say this is a solid asset, I don't agree, they have oversight committees. They have to answer to risk management teams, arms length risk management teams and oversight committees and pension funds and unionized collective pools. They can be forced to sell eventually based on underperformance. So even though it doesn't look exactly like a bank run, you can kind of create these parallel dominoes in the non-banking sector that is an effective run. For me, it feels like that's what I'm starting to see. And that's what I meant. Like, is this going to be a credit cycle of some similar pattern to the last two big ones we've had in the US and global markets?
Yeah, so you can the one person you didn't mention there is the regulator. Suddenly the regulator goes, "Oh, hang on, private credit." And we've seen that in the banking sector. The banking regulator has suddenly sat up and been like, "Oh, hang on, you need to disclose." A lot of that falls under what colloquially would be called career risk, right? So I think if I look at BDCs, and if I was an active credit portfolio manager right now, the own and my end investors are asking me, or maybe I'm an insurance company or a pension company, someone phones me up and says, "What's your exposure to private credit?" The answer I really, really want to give is zero. That's the answer I want to give because then the conversation goes away. It's
Right.
not a variation of "don't worry, I only own the good ones. I've done all my underwriting." We're past that stage. That was 6 months ago when everyone said we all have our own underwriting process and we're on top of it. The answer you want to give now is zero, which you can't because you own some. So the next answer you want to give is we're reducing. And I think I've got a colleague who I work with who looks at banks and goes and listens to bank CEOs and bank conferences. And banks are being asked this question by equity analysts. What's your exposure to private credit? Do you offer them leverage? Do you finance their portfolios? And what you're hearing is they're all saying, we're going to reduce that business. So there is a tightening of credit conditions
Yes.
for BDCs. There is a tightening of credit conditions for private credit. There's a tightening of credit conditions for the companies that private credit lends to. And that is essentially someone saying, I won't lend to you. And that ultimately will, down the line, lead to a number of defaults and restructuring. How big that number is a function of how long this goes on for. Right? Because if this is a 3 month thing and in 3 months' time we're past it, the number of companies that had to refinance in that window, 3 month window, and it was mission critical is very small. Once you get to like 12 months, there will be a significant number of companies that just couldn't put it off any longer and will actually have to fold or restructure, so on and so forth.
Interesting.
So
Interesting.
this is a self-fulfilling prophecy in some sense that gets to this point of once people believe something, it can get there. And I think to your point, this is something we perhaps would have gotten through fine were there not a change in the perception of default risks. And the change in perception of default risks I think, is going to be a much broader issue than just the software companies, right? So, if software companies got credit shut off to them, I mean, most of them, frankly, are cash cows, so most of them don't depend on it. So
Hmm.
I'm actually not convinced there would have been much of an economic effect. But now we're talking about a major macroeconomic event, the largest shut-in of crude petroleum. We'll see how long it lasts. My perception has been it's going to last longer than people think. But on a volume basis, this is bigger than we've felt with the 1973 oil embargo. Actually, the one people do not recognize how big it was, but Iran used to produce 7 million barrels a day at a time when global consumption was 80 million barrels a day, and they went like flat almost during the Iranian Revolution. That was a really, really big shock. We're now well into that. That's going to start to have significant effects. One of the things that is perhaps different this time is that the US, at least in theory, has the potential to shield itself from the rest of the world. The US actually is a net exporter, so it could shut off exports and be perfectly fine by itself, and everyone else has got a problem. So now we've got again this now it's not just transatlantic, it's trans-Pacific as well. How are you looking at this uptick in potential default risks affecting that chain that you were just talking about that becomes a self-fulfilling process? And I guess where would we look for what's going to be, where are the places that are most at risk in your view?
Yeah, it's a great question, and it's literally the one that we've been struggling with day by day, hour by hour for the last 2 weeks. Uh, so Europe's more exposed. You've seen that in two places. You've seen that in the credit performance where European credit's underperformed. You've really seen that in European government bonds. I used European government bonds because you could look at the risk-free rate in terms of Germany, or you could look at some of the EGB spreads like Germany, Italy. The market understands that Europe's exposed. The Coming back to the topic of the topic, the challenge has been that the narrative around the Trump presidency, rightly or wrongly, has been this phrase taco, this idea that Trump escalates to de-escalate. Um, and even if you don't agree with it, everyone kind of knows what you mean when you say that in finance. And so the challenge, particularly after Greenland, right? So everybody got really focused on Greenland. The president seemed so serious, and it was such a serious threat in every sense. And then it was just unbelievably fast reversal, literally within hours of standing up and giving one of the most, frankly offensive speeches I've ever listened to in my life. To then by like 6 p.m. in the evening send out a message saying, "Hey, do you know what? It's done. We're solved. We're cool. We've got this." And so the narrative around every policy that has come from the US has been it's escalate to de-escalate. There's some bigger plan, usually anchored in the midterms, and that's our grounding. And so, to your point, Iran war begins in Iran, and for the first couple of weeks, the market's pretty relaxed because we're just like, hey, we've seen this playbook. I think what you've seen over the last week is the dawning realization that that is potentially not the right narrative. Potentially not the right narrative. And if that's not the right narrative, if this is going to continue for longer, and the funny thing is, Marvin, I'll say this. Everyone I speak to says, I think this will last longer than the market thinks, which cannot be true. What they mean is everyone thinks it will last longer than the market's pricing. And that's because the market is trying to price some sort of modal price. It's trying to price the risk that we come in on Monday and at 10:30 European time before US markets open, a headline will drop and prices will move. And if you were trading on a view that this is going to get worse, you take an enormous mark to market loss. That
Mm.
is the challenge. Like what the president has successfully done, and I think you would agree with this. There is a lot of messaging to massage the markets while he pursues his policy objectives. Is he has the market scared. The market is constantly scared that he is going to say something, and we're all going to take a huge mark to market loss. On Thursday, Friday, you kind of got one of those social media tweets, and the market didn't move that much. And
Yeah.
it's a very large if, If we get to the point where the market stops being scared of President Trump's next tweet and actually focuses on, to your point, what's going on, there is a lot more that could and should be priced in. And one of the things that leads into that is there's a bit of a hysteresis effect about some of the blockades, which is, you know, if the Straits of Hormuz were to reopen and trade was to just magically be better on Monday, there would
Yeah.
be a certain amount of damage, but it would be transitory.
Mm.
But we're at the point where storage is full, some of the production facilities, which are flow production, back to my chemistry PhD, so you have a flow production for aluminium. You switch off the factory, you can't switch it back on again. These things are designed to run continuously and to never be turned off. And when you turn them off, it takes weeks and months to turn them back on.
Yeah. Mm.
So you get these hysteresis effects. Um, so the market is really, really struggling. It's really struggling because it can see the damage, but it's scared to put that into the price, given that you come in and you have headline lottery every day. So in terms of credit, you know, the timing has not yet been sufficient to cause material credit damage, but you're getting to the point where another month or two it will. Another month or two it will. Coming back to this thing, you know, if you go to a company and say, sorry, you can't refinance in March because Iran, but you can refinance in April, overwhelmingly the companies are fine, right? Let's just, you know, extend your lifeline for a month. If you say you can't refinance until September, October, November, December, there are too many companies that won't make that jump. The rise in costs is another problem, and the rise in interest rates is another problem for these more leveraged companies, for certainly certain industrial sectors. And what we've seen just in the last week, so the timing on this is very good in terms of this conversation. We've seen this shift from, I guess, three phase. Number one, trying to price around credit risk in software, credit risk in BDCs, credit risk in private credit, and huge amounts of issuance in AI technology. That was the real focus in January, February. Then it was what the hell's going on? But what you've seen in the last week is you've started to see price action really pressure what we would think of traditionally cyclical sectors like autos, like consumer retail. So the market is just now getting bold enough to say, do you know what? I think this is going to cause economic damage. And we will, each day that this conflict continues and the fallout from this conflict continues, I think you'll start to see that move and accelerate. My personal guess would be that the president will try and jawbone the market when he sees that happening. If we've crossed that Rubicon where his jawboning has lost its efficacy, that's when the market can really accelerate, you know, to the downside, and credit would be a lot wider. And then back to this self-fulfilling thing, we're suddenly going to realize there are a whole number of companies that need to refinance over the next 6 to 9 months. And if they can't, because the cost of refinancing is too high, financial conditions are too tight, there's only one thing you can do, which is you default and you restructure.
Mm.
Wow.
Yeah.
Look, this has been a really a fantastic discussion. Unfortunately, I think we have to cut it off here. I think there are so many different things. We might have to actually have you back because I think some of the issues that you raised really get into structural liquidity issues that Mark's done a lot of research on, and I think we should return to those at some point. But I'm very thankful that you took the time to come on with us. I certainly learned a lot. Mark, any final comment on this before we sign off?
No. I think we were just getting to the tension point in the argument there right at the end, which is this, narrative of the events that we're all watching that are happening externally versus the narrative of the demand that's available for private credit, potentially halting of its own accord. They've tried to be strong and stay there as they're rolling narrative shocks disrupt the market. But it feels like they're getting to the point where they might go on a bit of a buyer strike for internal reasons, risk management reasons, etc. And that's going to come at a very bad time, as Zoso highlighted, if people need to refinance in the next 6 months, because everyone might just sit on their hands for the next 6 months.
Well, thank you very much, though. So really appreciate you coming on. And any I know that you're in the private world, so to speak, again. But do you want to mention any places that people can reach out to you or find you or follow your work?
Yeah, so very elegantly put, Barn. So I do write a blog, which are my own personal opinions. Those of you who know me, or if anybody goes internet detective, will be able to work out what I do as a day job, which keeps me from being on this podcast more frequently. But just to be clear, these are entirely my own views. My thoughts come out every couple of weeks, and maybe coming all the way back to the beginning. Initially, I started writing because it was a way of maintaining my brand and my presence when I was between roles. But actually, I found it's a big part of my process, and so coming on podcasts like this, being forced to step away from the day to day and to look at the bigger picture, which used to be all of my job, is now actually a real privilege. And I think it still adds a lot to what I do. And so I try and maintain that. And then I share my thoughts for ex-clients, for ex-colleagues, and just really for anybody who wants a different perspective.
Yeah, that's well, thank you again. And what was the name of that blog? Because you didn't
That is
mention it.
macro credit thinking. Macro credit thinking.
Great. Thank you
Or
very
Google
much.
Zozo. That's usually works.
Yeah, Zoso, and that wouldn't have anything to do with Led Zeppelin, would it?
Google would disagree. I think we can ask, we've got AI bots now, but I think yeah, there's quite a lot of Led Zeppelin overlap there. And I do love that band. They make fantastic music.
Clearly, your parents did too. Thank you again, Zoso. Take care.
Thanks.